As we head into the weekend, the U.S. markets are closed. For the NASDAQ, trading concluded on Friday, November 7th, 2025 at 4 p.m. Eastern Time, and what a close it was for ePlus, ticker symbol PLUS. The stock finished the session at $84.88. That is a staggering 15.69% gain in a single day, adding $11.51 to its share price. When you see a move that explosive, a 16% jump on a day when the S&P 500 was practically flat, the immediate expectation is that this is a fluke. It's a short squeeze. It's a rumor. It's a one-day pop that will evaporate by Monday's opening bell. The expectation is to take your profits and run. But the reality of this situation, the fundamental truth of what just happened, is far more significant. That 16% spike wasn't a flare-up, it was a repricing. It was the market waking up to the fact that its entire perception of this company was wrong. The common belief about ePlus has always been that it's a value-added reseller or a VAR. This is a tough, gritty, and frankly, low-margin business. The market tends to lump companies like this into a simple category. They are middlemen. They move boxes of hardware and software from giants like Cisco or HP to other businesses. It's an important but not exactly thrilling business model. The expectation is for slow, steady, single-digit growth, a stock that tracks the economy and not much else. But the reality, as revealed by the earnings report dropped on Thursday evening, is that ePlus has quietly transformed itself. This is no longer a simple reseller. This is a high-growth, high-margin, complex technology solutions provider. And that 16% jump was the sound of the market realizing it was years behind on this story. Let's look at the trigger. The move was a direct reaction to the company's fiscal second quarter 2026 results. The numbers didn't just beat expectations, they completely dismantled them. Analysts were looking for adjusted earnings of about $1.23 per share. ePlus delivered $1.53. That's a 24% surprise on the bottom line. Analysts were forecasting revenue around $533 million. ePlus came in at $608.8 million, an almost 15% beat. But the headline number, the one that made every institutional desk at places like Fidelity and Interactive Brokers sit up and pay attention, was this. ePlus reported its first ever quarter with over $1 billion in gross billings. Let me repeat that. $1 billion. For a company with a market cap of around $2 billion, that is a monumental figure. This isn't just growth, this is an acceleration that challenges the entire thesis for what this company is and what it can be. The recent trading action tells the story. On Friday, volume for PLUS exploded to over 392,000 shares. To put that in perspective, its average volume is only around 176,000. This was more than double the usual activity. This wasn't just retail traders on the Robinhood app or SoFi Invest chasing a headline. The size of the move and the volume behind it signal significant institutional buying. This is what it looks like when Fidelity Brokerage and other major asset managers decide their models are wrong and they need to build a position fast. While many people are trying to figure out if Tesla stock will swing 5% on the new product tweet or if Nvidia stock has finally hit a ceiling, this small-cap tech stock just put up numbers that are fundamentally undeniable. This isn't the hype-driven volatility you see in Robinhood crypto trades. This is fundamentals-driven reevaluation. So, what does ePlus actually do and why is this happening now? The old expectation was correct in a way. The company has a technology segment, which does in fact resell products. That segment's sales grew 24.5% to $485 million. That's strong, but it's not the whole story. The reality is found in the margins and the type of sales. Gross billings for security products and services, think cybersecurity, the most critical need for every business today, were up 52% year over year. This isn't just selling a firewall. This is designing, implementing, and managing an entire corporate security posture. Even more telling is the services revenue. This is the high-margin, sticky, recurring revenue that the market loves. Services revenue increased 19.4% to $128.3 million. The company's consolidated gross margin expanded to 26.6% from 25.8% a year ago. In a business where you're supposedly just a reseller, margins aren't supposed to expand like that. It proves they are selling expertise, not just equipment. This shift is what separates ePlus from a simple box mover and puts it into the category of a genuine solutions provider. They're helping companies navigate their most complex problems: cloud migration, cybersecurity, and now artificial intelligence. The company even noted on its earnings call that it's seeing strong AI initiatives and recently acquired RealWave, a company with an AI-powered software platform. This is a smart, tactical acquisition that deepens their capabilities. This is the kind of move that a simple reseller doesn't make. This is the move of a technology partner. This changes the long-term investment case entirely. For someone doing their own online investing, this is the kind of deep operational detail that is often missed. It's not just looking at a chart on a trading platform, it's about understanding the why behind the numbers. When we look at the broader landscape, it's clear that this is a significant development. Many retail investors are looking for investment help or automatic solutions like Schwab Intelligent Portfolios. They want a set-it-and-forget-it approach. And there's a place for that. Using Fidelity ETFs or Fidelity mutual funds through your Fidelity IRAs is a sound strategy for long-term wealth. But for those who are engaged in self-investing, for those using an individual brokerage account to find opportunities, this is where the real work pays off. The people who saw ePlus not as a reseller, but as a services company are the ones who were positioned for Friday's 16% gain. The reality is that the market is a storytelling machine, and the story for ePlus just changed from a boring procedural to a high-growth thriller. Now let's talk about the future outlook and the risks, because no 16% jump comes without questions. The expectation might be that this was the big move and now it's over, but ePlus management immediately raised its guidance for the entire fiscal year. They now expect net sales to grow in the mid-teen percentages. This signals that the billion-dollar quarter wasn't a one-off. They have line of sight into a robust pipeline of deals. The catalyst is clear. Businesses are not stopping their digital transformation. They need more cloud, more security, and more AI integration, not less. ePlus is positioned directly in the path of that spending. But what are the risks? The reality is that this is still a highly competitive field. They're up against massive competitors. Furthermore, the business is still somewhat lumpy. It relies on large-scale enterprise projects, and if a few of those get delayed, it can hurt a quarter. A broad macroeconomic slowdown could also cause corporations to pull back on IT spending, which would hit ePlus directly. This isn't a stock to just buy on your Robinhood app and forget about. It's not a stable dividend payer like Apple stock. It's a growth story, and growth stories come with volatility. For the active trader, this is a fascinating setup. If you are using a platform like Interactive Brokers, which is known for its advanced tools and interactive broker fees structure, you're looking at the technicals. The stock just smashed through its 200-day moving average. It's coming off a massive earnings beat with huge volume. That's a classic bullish signal. But you're also looking at the option chain on your Interactive Brokers platform to see if the market is pricing in more upside. For the investor using a SoFi investing account, which offers both SoFi active investing and SoFi ETFs, the question is one of allocation. Does this 16% pop make the stock too expensive, or is it a sign that it's finally breaking out of its small cap shell? This is a great moment to reflect on your own portfolio. Comment below how many shares of ePlus you currently hold, or if this earnings report has convinced you to start a position. The core tension here is between the old story and the new one. The expectation was a $2 billion company acting like a $2 billion company. The reality is that it's a $2 billion company that is starting to post numbers like a company 2 or 3 times its size. Its security business is on fire, its cloud services are growing, and it's posting record-breaking billings. The market is just now catching up to this new reality. This is the kind of situation that experienced investors using sophisticated investing sites or Fidelity mobile app look for. They aren't just looking for Robinhood fractional shares of the big names, they are looking for the next big story. and ePlus just told the market that it is one. To summarize, Friday's 16% surge for ePlus was not an aberration. It was a fundamental and necessary reevaluation of the company. The expectation was that ePlus was a simple, low-margin IT reseller. The reality, confirmed by a stunning earnings report that beat on all metrics and showed a company firing on all cylinders, is that ePlus is a sophisticated, high-growth technology solutions provider. The company's first-ever billion-dollar billing quarter, driven by a 52% surge in its critical security business, proves that its transformation is complete. The market simply had to catch up to this new reality, and that's what a 16% gain on double the average volume looks like. The old story is dead. The new one is just beginning.